Hello and thank you for tuning in. Today we will be focusing on investing in domestic stocks. This presentation is brought to you by the California Society of CPAs. My name is Darrell Young and I'm a volunteer board member and the chair of the Financial Literacy Committee for the Peninsula Silicon Valley chapter of CalCPA. I operate a wealth management practice in the San Francisco Peninsula area. We intend for this presentation to be interesting and informative. The data points contained herein are believed to be current. Please note, however, that this presentation is intended to convey general information, which may not be applicable to your personal situation. Please do not interpret the information here as advice for your personal circumstances. You should consult with your personal advisor, or certainly feel free to give my office a call. As already mentioned, today's agenda will provide an overview of investing in domestic stocks. This presentation certainly will not make you an expert overnight in the subject matter. In fact, I would argue that people spend lifetimes trying to master investing in stocks. But what we hope to cover in 12 or so minutes in this presentation is to touch upon the high points. So you see there on the left-hand side our agenda. We're going to look at what a stock is, basic ways to analyze stocks, their various categories, talk about some strategy or asset allocation ideas, talk about tax effects. But before we get into all of that, also wanted to reiterate what we believe to be the cornerstones for financial success. And to us, those are planning in accordance with your goals and risk factors, giving back to your community, working with people whom you respect and trust, and maintaining a positive attitude and competitive awareness at all times. If you are achieving these four things, we believe that you have the makings for financial success. We also believe that time is our most precious resource. There are no shortcuts to financial success. So what are stocks? In very simple terms, a stock is a unit of ownership in a corporation. It trades like any other marketable security. And when you hear the word stocks, I think most people generally assume that you're talking about common stocks as opposed to preferred stocks. So you see there the distinction below. Common stocks offer you voting rights and dividends if the company issues dividends, but you also receive lowest priority in, say, a bankruptcy or liquidation scenario. Preferred stock, on the other hand, functions more like fixed income, which may have some characteristics or may be convertible to common stocks. But again, for the purposes of this conversation here, we're going to be focusing on what most people refer to in stocks, which is the common stock. Also, we're also going to focus on domestic stocks, which we know to be stocks that are domiciled in the United States, trade on a United States exchange, and for our intents and purposes, we recognize that foreign companies can also list their shares in the United States. A recent example being the company Alibaba, based out of China. Also of note, normal trading hours are 9:30 to 4 o'clock Eastern Time, which translates to 6:30 to 1 o'clock p.m. Pacific Time. Some of you may have come across the term after hours trading. I would say to you that that mainly refers to institutional or professional traders. And those are the regular trading hours, but you may have also noticed that certain days tend to be half days, such as the Friday after Thanksgiving is traditionally a half day. How about stock quotes? If you go to a basic internet search engine, you might see a stock quote that looks like this. We're looking at the stock quote for Google. During market hours, the price, of course, would be changing all the time. Some of the terms that you may have heard before, such as the ticker symbol, highlighted in green there. Oftentimes, it's a short version of the company's name. We've also highlighted the bid and the ask price. The bid, of course, is what a buyer might offer you for your shares. The ask, of course, is what a seller might want in terms of selling the shares. And the difference between the two numbers is often referred to as the spread. Other types of information that are represented there, the days range, which of course represents the price from high to low traded that day. 52-week range, similar idea, but within the last year. We'll look at volume later on in the presentation. So again, these are the basics of what you might see in terms of a stock quote. How about a stock chart? Now again, using the same stock, Google, we see the price represented in chart form over a period of time. Now those of you who are chart enthusiasts might take this a step further and look at moving averages, meaning that you want to look at the price and how it's moved over a particular time period. Common time periods could be 10 days, 30 days, 50 days, etc. And so you see that black line there, which is a smoothed out representation of what a moving average might look like. Also, you might want to marry this with looking at trading volumes. And so, again, looking at how many shares have traded during the particular time period being examined. How about stock fundamentals? Now, let's say that you have participated in some stock trading. You perhaps have looked at an IPO registration statement. Again, think about Alibaba, which just recently started trading in the United States. Perhaps you looked at, again, their registration statement related to their initial public offering. And then going forward, public companies, as required by the SEC, need to file their Form 10Q, which is a quarterly report. So you see that 3 times a year. And then the Form 10K, which is the annual report. Now, we just have snapshots here, but the actual documents could be quite lengthy. For example, the Form 10K could easily be several hundred pages long. And it would include not just management commentary, but also financial statements and footnotes. So again, plenty of interesting reading for those who want to get to know a stock very well. Now, how about analyst reports and their recommendations? So the snapshot on the right-hand side is really just a summary of what many different analysts think about Google stock. Let's refer to the stock rating. Oftentimes we hear these terms such as buy, hold, or sell, and the words mean exactly what you think they mean. So if you see a buy rating, you know that the analyst is recommending investors to buy the stock. Typically, the analyst will also offer a price target, which means usually what that analyst thinks the price will be at in 12 months or so. And oftentimes, they may also issue earnings estimates, since companies issue their earnings reports on a quarterly basis, as we just saw with respect to the 10Q. So again, for what it's worth, these analysts put forth their projections for consideration, and if you take them all in summation, you might refer to that as the consensus for what analysts are saying about a particular stock. How about various stock categories? So we see here that stocks can be looked at as either growth stocks versus value stocks. A growth stock might, for example, be something like a Facebook, where the company is growing at a rapid pace. In contrast to perhaps a value stock, let's think of a stock like Intel, which makes semiconductor chips that go into computers. And so again, you see the distinction there between stocks that are expected to grow at an above average pace versus stocks that one perhaps believes trades at a low price relative to its fundamentals. And we just discussed fundamentals with respect to those previous SEC reports. And you could have stocks that fit neither category, or they are somewhere in the middle. How about capitalization, which refers to the size of the company? So as I just mentioned, Intel, which some might feel is a value stock, I think you would also consider them to be a large cap stock. It's a large company. Large cap stocks also include blue chip stocks, well established, large, ideally financially stable, versus smaller or mid cap stocks. And again, the scale of what is large versus what is small or medium sized can vary from one person to another. Let's say for our purposes that a large cap stock would be those that are greater than $10 billion in size, and call small stocks 1 to 5 billion, and mid cap 5 to 10. You may also see mega sized stocks, those that are greater than, let's say, 50 or even 100 billion. Now, in terms of strategy, knowing what we now know, how would one look to invest in stocks? Now, if you take a diversified approach to stock investing, you might instead focus on your asset allocation. And you see here examples of what is considered to be conservative to aggressive. Notice on the conservative end that the person has a smaller amount of exposure to stocks, which you would say perhaps is more risky to invest in stocks, but they also, over a long-term horizon, offer you greater reward potential. And again, within stocks, you see how it's divided there between the purple, domestic, versus the light green being foreign stocks. Again, this is an example of what an asset allocation might look like for anywhere from conservative to aggressive. The idea, of course, being that the more aggressive person has a larger allocation to stocks. Now, looking at the overall market, there are different ways to look at how stocks behave. Some of the indices that you may have heard before, the S&P 500, which for our intents and purposes represents the 500 largest and most successful stocks in the United States. Perhaps you've heard of the Dow Jones Industrial Average, which represents 30 stocks. The NASDAQ Composite and the Russell 2000, the Russell representing, in this case here, smaller size stocks. And why do these matter? Well, I think that if you look at, for example, the S&P 500, many investors might consider that to be the benchmark for how the United States stock market is performing. So if you, for example, looked at the S&P 500 and you said, well, it's up 2% as of today, how is your portfolio doing relative to a benchmark such as the S&P 500? And that is how investors might use the information. Let's look at another way of looking at stocks, which is by sector. So you see here the various terms such as information technology, financials, etc. I think that a lot of the names here are intuitive. So for example, in information technology, you might find Intel in that particular category. Financials, how about Bank of America? Healthcare, perhaps you find a biotech company such as Amgen. Consumer discretionary, I look at as consumer-based products that are, you might say, non-essential. So how about vacation companies, etc. I suppose sometimes you find stocks that might fit into several different categories. So for example, Apple. Apple as a company makes computers, makes phones, other types of devices. Do you consider Apple to be an IT company, or would you consider them to be a consumer discretionary company? So again, like I said, I think that certain companies may straddle the line at some point, and one person's opinion does not necessarily match another's, but you see the general idea is to look at stocks, and one of the ways that you can distinguish between them is by sector. How about macro market conditions that may affect stocks in general? Interest rates, certainly, gross domestic product, currency exchange rates, the prices of various commodities such as oil, geopolitical tensions. So there's plenty of factors that may move the market and move all of the stocks in the market, and these are some of the main areas here. How about tax effects? So IRS Publication 550, and you see the snapshot there on the right, provides a great amount of information to help investors understand what some of those tax consequences might be. Let's cover just a few very simple ideas in brief. Long-term versus short-term capital gains. So you see here that short-term represents 1 year or less as far as your holding period. Long-term is for greater than 1 year. Let's take a look at the example. So the person here showing a capital gain, you see that the purchase was made in October of 2013, and that investor sold the investment in February of 2015. Clearly, that's over a year. Purchased for $3,000, sold the stock for $5,000. Naturally, there is a gain of $2,000. And of course, we consider that long-term because, as mentioned, the holding period is greater than a year. That same investor also purchased some stock in December of 2014 for $6,000. 2 months later, sold it for $5,000. So there you have a short-term loss of $1,000. One other point of note, advisor fees. If you are using an advisor to help you manage your portfolio, and assuming that that portfolio helps you to produce taxable income in any given year, those advisor fees may be deductible. So we tried to cover a lot of ground in today's presentation. Again, this is not intended to make you an expert. As I've already mentioned, investors can spend an entire lifetime trying to master trading in domestic stocks. Now, for your reference, we hope to do future presentations to cover other topics such as foreign stocks, mutual funds, short selling, and the like. Hopefully, you were able to get a good amount of information from today's presentation. As I mentioned earlier, my name is Darrell Young. I thank you for your attention. I hope that this was informative to you. I welcome comments from you at any time. Thank you for listening.